I hope you have all tried to look at the questions for this seminar. All these questions are based on calculations, and they are really just about valuation models. So for seminar 3, you were asked to try questions in section A and B, that is the method of comparables and some basic dividend discount model kind of calculations. So what we shall do, I firstly want you to tell me, please, maybe just post something in the chat if you have tried these questions at home, right? So I want to know whether you have actually tried them at home, because what I'm going to do, I'm essentially going to go through the solutions, assuming that you have actually tried the questions so that you know what the questions are, and we are simply going to compare the solutions that I have with the solutions that you probably have created. So can you please in the chat room show, I mean, if you try this question, just post yes. So I just want to see how many people roughly from the class. Right now I have 117 people here. Try these questions. Okay. Thank you. Keep saying yes, please. If you have, of course. Okay, I see. I see that some students have tried it, but it doesn't look like the majority of students have. Which is not ideal, really, because the expectation is that we will be looking through the solutions with your prior understanding of the question, at least. Okay, let's start with the very first question then. Let me just move the list of questions in front of you so that we see what the questions are, and share my screen. Okay, so this is what we're talking about. We're talking about this very first question here. And as you can see, it is about the method of comparables. So if you haven't read the question, please spare a minute or two to read the question to understand what it is asking. In this question, you need to use the method of comparables to estimate the intrinsic value of Iceland stock. Okay. Here above, we have some financial data on the comparables and Iceland. So these are the companies that are essentially our peers or our comparable firms. And this information, essentially this information, is collected from these companies' annual reports. I mean, free cash flow is obviously just worked out. Equity market value is this company's market capitalization as of the date when this information was collected. Okay, this is not a very fresh set of accounts or information, so this is quite old. So I can't remember which year that it was when I created this example, but these at the time these were real figures, real numbers from real financial statements. Okay, so we have the equity market value for each company, including Iceland. So again, a reminder: this is the current market capitalization as of the date of the valuation. The other numbers, the book value of equity, reported earnings, they would be coming from the annual reports, financial statements. So what we need to do, required, is to use the method of comparables to estimate the intrinsic value. Now, if you recall, under the method of comparables, there are a number of ways you can estimate the intrinsic value or the relative valuation of your target company. Our target company is Iceland, or the company of interest rather than target is Iceland. So let's say we are going to try the part one, which is use the price to book multiple. How do we estimate the company's Iceland's intrinsic value? Sorry, let me just quickly see if more people are in the waiting room. Looks like there might be. Just a second. Okay. Yeah, I need to add more people. It's not efficient. Yes, so for the price to book multiple, let's just remember the steps, what the steps are. What you need to do is to compute the price to book multiple for each of your peers. So you have 4 peers here. The way you compute the price to book multiple, you just divide the market equity value of your company, let's say M&S, Marks and Spencer. This figure divided by this figure would be the PB, or the price to book multiple for M&S. Then you do the same for Morrison's. It is this figure divided by this figure. That would be the price to book for Morrison's, etc., etc. So you do this activity for all 4 companies, and you will get essentially 4 price to book multiples. Then what you do, you compute the average of these 4 price to book multiples to get the kind of peer average price to book. Peer average. So what is the sector average or peer average price to book for your peers? That would be the average of these 4 price to books. Pay attention that you don't include the company of your interest in that calculation, because you don't want to double count things, or rather bias the results. You only need to use the peers to evaluate or to estimate their peer number, multiple number, so that then you will be anchoring the valuation of Iceland on your peers' valuation. So let me just quickly go to an Excel spreadsheet where these calculations are done. So what I've done, I've just basically added the price to book, price to earnings, EV to EBITDA, EV to sales, EV to free cash flow columns, and I've calculated it. So for the price to book, what we have, price to book is, as we see from the formula here in Excel, is the multiple of this number to this number. Basically, this divided by this, okay? And we do it for all 4 peers, and then we average these 4 numbers, and that would be our peer average multiple. So 2.2 here is the average of these 4 numbers. So as you can see from his formula in Excel, our peer average price to book multiple is 2.2. How do we then value Iceland? What we need to do, we need to multiply the peer average multiple by Iceland's book value. Why? Because if Iceland is to be valued in line with peers, its price to book should be the same as the peer average price to book, which means its price should be such that by dividing it by its own book value of 282 should give you exactly the same multiple, 2.2. Hence, to calculate Iceland's intrinsic value, what you need to do is you need to multiply your peers' average price to book multiple, which is 2.2, as you can see from this formula here in Excel. You need to multiply it by Iceland's book value of equity, right? So that's where 6 to 6.8 comes from. And we carry on doing the same thing for PE. So in PE, what we have done, we first of all calculated the PE for every company that we have here for each of the peers. So 14.2, for example, is our company's Marks and Spencer's equity market value divided by its reported earnings. Yeah. So as we see, the formula is B3 divided by E3. So that's 14.2 comes from. And in the same way, we calculate all these other figures for the peers, and then we average them and get 16.2. So this is basically our peer average price earnings multiple, or our sector's multiple, whatever we define as peers. And then if we want to value Iceland by utilizing peer average PE, what we do, we need to multiply that average PE by Iceland's earnings, which is 29. So in this cell here, which is 470, this is what exactly we have done here. So 470 is our valuation of Iceland based on peers' average price earnings multiple. So 470 is just your peer average multiple for PE, which is 16.2, times Iceland's earnings, which is 29. Okay, so you see here this formula in Excel again. So that's your PE done, PB done. We can then move on to the next multiple, EBITDA, which is also part of our requirement here. So we also, as you remember from the question, we need to calculate enterprise value to sales, then enterprise value to EBITDA, and also to the cash flow. So let's just quickly run through these numbers. The logic is the same. You compute the EV to EBITDA, but be careful here because the numerator now, here, the numerator is not price, not the market capitalization of equity, but the enterprise value. And what is enterprise value? That's your equity market value plus the company's net debt. So the numerator here, make sure that you add net debt to the market value of equity. Right? So let's now look at each of these multiple as they are calculated. In terms of the formula, what we have here for 5.1, we have the companies, in this particular case, this is Marks and Spencer. So we have Marks and Spencer market value of equity plus Marks and Spencer's value of debt, which is this part in the numerator, and then divided by all of that divided by Marks and Spencer's EBITDA, which is this number here. Yeah. So this is your EV to EBITDA. And we carry on doing the same calculation across all the peers. And as we did in previous examples, we average these EV to EBITDA, these four numbers, and we get 5.1 as the average, peer average, EV to EBITDA. The next step would be to do what? The next step would be to apply the peer average EV to EBITDA to our companies, to Iceland's EBITDA. Here is what we have done. So we multiply the peer average EBITDA, 5.1, which is H7 as in terms of the Excel cell, by Iceland's EBITDA, which is 163 million pounds, which is sitting in Excel cell G10. Okay, but recall, if we just multiply these two numbers, the result will be the estimate of the intrinsic value or the comparable value of Iceland's enterprise, the entire enterprise. But we're not really asked to estimate the enterprise value. We're asked to estimate the intrinsic value of equity. So we need therefore to subtract net debt, which is this bit in the formula here that I'm highlighting here in Excel. So we need to subtract the net debt of Iceland. Right? So that's the only difference that we need to be careful to account for when we are utilizing enterprise-based multiple. Essentially, for every multiple that is enterprise-based, EV to EBITDA, EV to sales, or EV to free cash flow to the firm, we are going to use exactly the same approach where we are adjusting or removing the effect of net debt at the end to get from the enterprise value estimate to equity value estimate. That's how we have estimated these three figures. This figure, this figure, and this figure. Okay, I'm not going to now go into sales and free cash flows because the approach is identical. So essentially what we now have 1, 2, 3, 4, 5 different estimates of Iceland's intrinsic value. As we can see, all these estimates are vastly different from one another, from each other. And if you then compare these estimates with Iceland's actual current market capitalization, you will see that maybe for the vast majority of our valuations, it looks like Iceland is currently undervalued or cheap or underpriced, right? Because it's currently trading at 323 or whatever million pounds, its market capitalization. However, if it were valued in line with its peers, based on price to book, it should have been actually trading at 626. So that's our estimate. Or if we were to value it using the PE multiple, in line with peers, its intrinsic valuation would have been 440. So, and EV EBITDA, again, same. I mean, these three numbers are greater than 323. And also the last number, EV to free cash flow, is much, much greater than the current price or current equity value or the market cap as on the day of the valuation. So if we are making an investment recommendation, we're probably just looking at these four numbers. Let me just not highlight this one. If we only based our valuation on these numbers, on these four numbers, 1, 2, 3, 4, they all are much greater than the current valuation, current price. So maybe our investment recommendation should be buy. Okay, but you see here we have in this question, we need to, so we kind of stated the appropriate investment recommendation for each of the above estimates. But the issue is, what kind of issue do we encounter in this process, right? Which is the part C of this question. Well, the kind of issue we encounter is that if we were to choose to use just the EV to sales multiple, or if we believe for this sector or for this sort of company, EV to sales multiple is better, well, then the output result will be completely opposite, right? Because EV to sales multiple gives an intrinsic valuation of 207, which is actually much smaller than the current valuation. So based on this multiple, our company appears overvalued or expensive. So this is the issue, unfortunately, that whether we like it or not, we need to be able to, as analysts, we need to be able to address and make our judgment as to which approach is relevant or good. Perhaps you could just use the average of all of these 5 measures if you have no conviction as to which one is better one or more appropriate, and just average these 5 multiples based valuation, which is summarized here, this number here at the back, 6, 7, 9, and maybe that would be your estimate of intrinsic value. So obviously it comes at a much higher valuation than the current intrinsic value. So this is how you would approach the first question. By the way, of course, I will put on Moodle the solution, this Excel spreadsheet for you to have a look at. So I hope I haven't made any calculations mistake here.
Sorry, excuse me.
Yes, please.
Sorry for interruption. I think the J8 couldn't be some mistake. Yeah.
Oh, well done. Excellent. Excellent. You are absolutely right. It is it's a mistake. Yes, let me see if this okay. Well done. Thank you very much for spotting it. So I need to so the mistake is this number should be
0 point times.
yes. Yeah, let me
0.9
just
times.
do it. So it has to be J7. Well done. Thank you so much. Thank you so much. You see, I was quite sure I might have mistyped something. That has to
Thank
be
you.
J7 times the company's sales, which is this cell, right? Minus the company's debt. Am I right? Which is this cell here. Ah, so the valuation is completely different now. Let me quickly check whether this is correct. So J7, which is the average peer multiple, times our company's sales, which is I10, which is correct, minus our company's net debt, which is cell M10. Yeah. Okay, guys. So you see, indeed, the valuation now changes massively. So what we have in this particular case is that across all 5 multiples, we have a strong signal that our company is actually massively underpriced. So just because of this computational mistake here that I've just forgot this, mistype the formula here. So we had a massively different valuation, but now it looks like all our individual multiple valuations point in the same direction. But it doesn't. Nevertheless, it doesn't clear the issue that still this method as a method potentially could generate vastly different results. Imagine if our company's current value wasn't 323, but let's say it was 700, right? Let's say it was 700. In other words, it is somewhere in between these 2 high numbers and these 3 low numbers. So essentially, again, we would end up with a situation that on some valuation metrics, we will get a signal that our company is underpriced, but on the others, we would get that our company is overpriced, something like that. Okay, so this is one of the issues or limitations that we should note when addressing this method. So basically, when answering part C. So I hope this makes sense. Let us now just quickly move to the next question. So our next question is again about utilizing the method of comparables. I don't know whether you have had a chance to read it, but please spend a couple of minutes to read this question first. And I'll quickly run you through the solutions. In the meantime, if you have any questions, please just come live and ask. Perhaps it would be better if you just ask it rather than type it, because my screens are congested and probably wouldn't see the messages coming through. Okay, there is some message, I guess. So I'm just leaving this question to you to read and try to make sense of it first before I show the solutions. In the chat room, there is a question about EBITDA. Let me see what you mean. Too many screens here. Struggling to navigate between different open screens. EBITDA. Okay, I mean, guys, whilst you're reading, the person who asked a question about why EBITDA should add net debt, I'm not sure what you mean by why EBITDA should, but if you're referring to the EV to EBITDA multiple, then because EBITDA is earnings before interest and tax, depreciation and amortization, so essentially these are your dirty earnings, or almost like free cash flow to the whole enterprise, because it includes the interest, and interest is the earnings of the providers of debt capital. So it's not just the earnings that are attributable to equity providers, but also the providers of debt. So your denominator is something that shows value created for the providers of all types of capital, entire enterprise. So should be your numerator. That's why you add debt to the market value of equity in the numerator. And when you are using this multiple, EV to EBITDA, your estimate would be the estimate of enterprise. And that's the reason why when you are working out the estimate of equity, you need to take out the value of net debt from that estimate. I hope that answers the question, or probably, I'm not sure if that was the question that you had. Okay, so I'm assuming that you have read this question. So what the question is actually about is you have this company, online trading or basically brokerage company that was executing trades. And the company at this peak of the dot-com year was trading at an astronomical market cap of 56 billion. So it had a market capitalization of 56 billion. And the question here is about if we were to use the method of comparables, essentially, and given that all other companies operating in this sector, let's say brokerage companies executing trades for their clients, if those companies are valued at the price to sales multiple of 1.5, what sort of volume of transactions would have justified the valuation for this company, for Charles Schwab? So what sort of volume of transactions, and this is important, because if you're a brokerage house, when you exercise a transaction for your client, you're charging a commission, right? So in this particular case, the commission they charge is 0.25%. So that's not 25%, that's 0.25%. That's basically a quarter of a percent. That's the commission that they charge. In other words, if, let's say, the client sends an order to buy $1,000 worth of stocks, how much commission will I earn? Will this company earn? They will earn just a quarter of a percent. So what's a quarter of a percent? That's just $2.50 out of 1,000. Right. So that's important to understand. That's not a 25% or 2.5%. That's actually 0.25% on the traded amount. And it is by accumulating these percentages that the company is charging, these fees, the company is generating its own sales. So for a company like brokerage house, what is their sales? Their sales is all these commissions that they've been charging to their clients. Yeah. So the question, therefore, is, if we read the question carefully and try to think about it, is how much trading should this company have executed? So how much in dollar volume, in dollar terms of trading, should this company have executed or processed, so that by earning 0.25% of commission, they would be able to generate sales, right? That would result in a price to sales multiple of 1.5. Why? Because if our company, if Charles Schwab's equity is valued in line with its peers, then its price to sales should be 1.5. So its essentially equity value, 56 billion, divided by some sales, S, should be equal to 1.5. So let's see how we can quickly solve it. It's a very quick solution. Once you understand what happened to my Excel spreadsheet, where did it go? Once you understand what the question is about, the solution is sort of quick and easy. To summarize, so our company's current market cap is 56 billion. The peers price to sales is 1.5. If our company were to be valued correctly or in line with the market, its price to sales should also have been 1.5. Right now, assuming it is valued correctly, what sort of sales therefore are implied? So the sales that would be implied would be your market cap, 56, divided by your company's implied price to sales multiple of 1.5. So 56 divided by 1.5 would be 37.33 billion. So that would be the sales, okay? So that would be the implied sales that the company should have banked or should have booked. But to get this much of sales, to get in that given year, to get 37.3 billion of sales, what should have been the volume of executed transactions? Remember, you are only receiving 0.25% for executing your client's orders. Let's say £1,000. From £1,000 of execution, you get to $2.50. But here, you're getting 37 billion. It means you've executed what? How do you work it out? You need to divide this figure, therefore, by 0.0025 to get to the volume of transactions in dollar terms. To generate these sales, therefore, you need how much of turnover in terms of your executed transactions? You need 14,000 billions, which is basically $14.9 trillion of executed trades. So I hope this makes sense what this means. And essentially going back to the question whether this is, for instance, realistic or not, this clearly is unrealistic valuation because the whole of the US stock market in that year had a turnover or executed trades of about only 20 trillion. So it looks like about 80% of that was just done by Charles Schwab, which cannot be correct because that's just one of a large number of brokerage houses that were executing transactions. So from this calculation, we could conclude that our valuation, the current trading value or trading price or market cap of this company is massively inflated relative to the valuation of its peers. Okay. So that's the solution and answer to part 2. But again, as I said, if there was something that you weren't quite clearly sort of grasping as I was talking, this solution, I will put the Excel spreadsheet under this exercise on Moodle, so you will see the solutions for this question and you can work through it again. So let me now move on to the next 3 or 4 questions, actually 5 questions on dividend discount model. Again, I'm assuming that most of you would have already looked at it. The first 3 questions are very simple. I mean, the first 3 questions are very basic, so I'm not going to spend much time. So the first question is asking, well, suppose your company is going to pay 1.1 euro dividends next year, and its price 1 year from now, the price of the stock will be this much, 53.55 euro. So what should be the fair value as of today? I think this is a very basic question, isn't it? So the fair value as of today should be just the discounted value of your future dividends and your future price. That's it. So essentially 1.1 plus 53.55 discounted back over 1 year at 9%, which is 1.09. That would be your answer. So in terms of the actual solution, that's just as short as this. So 53.55 plus 1.1 divided by, basically we're discounting over 1 year period back to the day at 9%, 1 plus 0.09. So your answer is 50. Okay, so I assume, I hope you find this easy. Next question is not much different. Again, question 2. So let's just see what is the right answer. A company's dividend at the end of year T+1, so basically next year, is expected to be pounds. And thereafter, the dividend will grow indefinitely at the rate of 2%. So your long-term sustainable growth rate essentially is going to be 2%. The cost of equity capital is 7%. So what should be your value today? Well, given that your dividends are growing at a constant rate and all this information provided, you just need to use the golden growth model, isn't it? So use the golden growth model, which says value today is equal to your next year's dividend, capitalized at growth adjusted cost of equity capital. So in terms of the solutions or numbers, the solution would be this. Next year's dividend, 10, divided by cost of equity capital 0.07 minus growth rate 0.02. And this is simply your golden growth model. Hence, the answer is 200. So the correct answer in this instance, therefore, is D. D is 200. So this is our correct answer, 200. Again, I'm not spending too much time on it because I guess that's a very basic question. Next, question 3. Again, very similar in a way. So the share of Nike traded at $55 per share at the beginning of year 2008. Okay, so the particular attention should be paid at this. It's the beginning of 2008, so the start of year. And the shares closed $67 at the end of 2009. So how many years apart do we have here? Start of year 2008 and end of year 2009. So we're talking about 2 years, right? So don't get confused with, even though the years are just one apart, but actually here we're talking about 2 years because your stock is trading 55 at the start of the year 1, but then they are valued or they are trading at 67 at the end of year 2. So in between these two numbers, there are 2 full years. So whenever there is any discounting or compounding, we will be doing that activity over a 2-year period. Okay. And we also have here statement that Nike paid a dividend of 90 cents per share at the end of year 2009. So at the end of year 2, when the price will be 67, the company also pays dividends of 90 cents. So what was the annual return to holding Nike share during the 2-year period? In other words, let me just translate this because a number of people might not necessarily appreciate what this question is about. So what is the return, annual return from holding the Nikes? In other words, that's what's the implied rate of return, or what's the implied discount rate, essentially. In other words, what discount rate will equate the future value of 67 plus 90 to the present value of 55? Again, that's an easy question with an easy solution. Let me just go quickly here to the solution. So the present value today, 55, should be equal to, the current price today, P0, 55, should be equal to the present value of your year 2, price plus the dividend that you will receive at year 2, right? So we are discounting the future value back to today over 2-year period. So 1 plus r to the power of 2. That's what we are doing. So let me slightly increase the font so that we can see what it is that we're doing here. Okay, so that's it. So this is the formula. From the formula, we can work out r. So what is r? R is simply the square root, well, the square root of this expression here. Okay, from this formula, from here, you can work out r. You basically put your r on the left-hand side, and you will realize that r is just the square root of this expression here. And plugging the numbers in here, you will get an answer. So these are the numbers here. So the square root of 67 plus 9 divided by 55 minus 1. So your answer is 11%. Yeah. So 11% is your answer. Again, we can look at the solution later, but I believe this is a fairly simple question. let me guys try to run through all these solutions, and if we have time left, please feel free to start using your chat. I mean the chat, the forum. Sorry, the chat section to place any questions you might have. But let me try and finish these remaining two questions first. Now let's move on to question 4. Again, I want to give you at least a minute to read through it. For some of you who haven't read it before the seminar or haven't attempted it, so I'll be quiet for a minute to give you time to read, and then I'll present the solution. Okay, so I'm assuming that you've had the chance to read the question now. We're going to solve the part A, sort of similar to what we've done in previously questions. So a stock is trading at $42 at the beginning of 21. Its beta is 1, risk premium, market risk premium 6%, risk rate is 2%. And we assume the company pays no dividend. So at what price should you expect this firm to sell at the end of 2022? Again, pay attention. This is the beginning. 42 is at the beginning of 2021. And we are expected to generate its fair value, or guess what its fair value should be at the end of year 2022. So that means 2 years, 2 years forward. Okay, not 1 year forward, but 2 years forward. Because beginning 21, from beginning 21 till the end of 22, we have 2 years, 2-year period. Essentially, what the question is about? The question is about finding the future value of something which has present value of 42. In other words, we need to find out just the future value of 42 2 years from today. Okay, so let's just do that quickly. Go to question 4. The first thing we need to do is obviously to work out the capital asset pricing model based cost of equity capital estimate, R. So using the capital asset pricing model, our R for this company should be the risk-free rate of 2%. I believe it was 2, isn't it? Let me quickly check. Yes, the risk-free rate of 2% plus company's beta times the market risk premium 6%. So we have 2 plus 1 beta times 6, and it gives us 8%. So the company's expected rate of return for equity, or the cost of equity capital, is 8%. So if it is 8%, if today's price is P0, let me slightly increase the size of the screen here. So if our P0, and we know today's P0 is $42, and our R is 8%, and we receive or pay no dividends, then the future value would be just, we need just to compound it over 2-year period at this rate, right? So P0 times 1 plus R to the power of 2. So essentially 42 times 1 plus 0.08 to the power of 2. So we're compounding at 2 years. And that gives us 49. So 49 should be our company's intrinsic value or fair value, or whatever is the word, 2 years from now. Okay. Or you could alternatively state the present value of 49 at 8% as of today is 42. So that's how we answer part A of this question. Let's now have a look at the part B of the question. So here we are just throwing in one more item, is that this company now is going to pay dividends for the following 2 years. Right? In the previous case, we had the company has no dividend payment at all, but now we are assuming that the company is going to pay $1.6 in dividends the next year and the year after. So what should therefore be the price at the end of the year? Recall that the price today is still the same, 42. So if you just step back for a second and think logically, should even before doing any solution, doing any calculations, do you think the future price should be higher or lower? Can you guys use the chat? Maybe just sound whether you think the future price should be higher or lower. Correct. The future price should be low. Absolutely correct. Okay. A number of people have suggested the future price should be low. This is absolutely right. Why? Because today's present value reflects the present value of, today's price is the present value of your future value, but also the future dividends. Now, because you're getting dividends in the future, it means your price at the end of year 22 should be a bit lower, so that your present value of these three cash flows, which is dividend 1, dividend 2, and the price at the year 22, still equal 42. So how we solve it? We solve it as I've just explained. So the P2 today should be the present value of your price 2 years from now, minus the dividend that you receive in the first year, discounted back by 1 year, and minus the dividend you receive at the end of the second year. Not discounted, but rather compounded by 1 year, and minus dividend at the year end 2. So that would be essentially your solution, and now you will get a price of 45. And you can quickly check that this is correct price, because if you discount 45 back to today, as well as add to that a discounted value of dividends for the 2 years back to today, you will get the current price of 42. Okay, so that's I guess what we get here as a solution. Now, finally moving to the last question for today's seminar, which is question 5. And again, I want you to spend maybe a minute or two to read through it. And this is based on the use of the H model that we covered in one of our evaluation topics in Unit 5. So please spend a couple of minutes, read it through, and then we will run through the solution quickly. Okay, so in this question, the long story short, we have a situation where dividends are expected to grow at a changing growth rate over the first 6 years. And the way the growth rate for dividends is changing, it's actually going down. So in the first year, the growth rate of dividends is assumed to be 24%. And then in a linear fashion, it will go down, the growth rate will go down to 6% over a 6-year period. So essentially, it looks like sort of your G is not constant, but it sort of drops from year to year in a linear fashion. And then starting from year 6, it just stays at a constant growth rate of 6%. So if that is the pattern, then we actually have a formula for it. The formula is the H model, something that we cover in Unit 5. So basically, you need to use the H model formula and just plug the numbers in it. Okay, I'm just going to switch to Excel right now and show the formula and what we are doing here. So your H model is this one here. So value today, or intrinsic value today, is your today's dividend times the 1 plus the long-term growth rate, or this growth rate that will settle after year 6, divided by R minus G long-term growth rate, plus today's dividend times H, and H is the half-life of this declining dividend growth period. In our case, our full period over which it is declining is 6 years. So half-life of it, or half of that period would be 3 years, 6 divided by 2. So half is 3 years. And then the expression in the brackets is self-explanatory. So what all we need to do is just to plug into this formula the values of each of these parameters here. So if we just look at the calculation here, what we have, D1 is 1.37 plus 1 plus this growth rate, that is our starting growth rate, high growth rate. Sorry, I'm just looking. Have I made a mistake here in the formula? Looks like, guys, I think I've made a mistake. It shouldn't be 0.24. I think it should be 0.6. I believe I made a mistake. If that's the formula, I think we need to put in 6, not 0.24. Let me just correct it quickly. 0.6. I hope there are no further errors in this calculation. Yeah, so the answer changes a bit. Hence, we need to change the answer in the other bit as well. 54.8. I'm just going to make the changes right as we speak. Basically, what I've done, this is in this formula we have 1 plus GL, which is the long-term growth rate, but in the calculation I mistakenly put in the value for the short-term growth rate. But now it's, I think it's corrected. So by plugging the numbers here in this formula, we see that the value comes at $54, or whatever, or pounds. Yeah. So that's the answer to part A. The answer to part B. Is XYZ fairly priced? Well, to be able to answer this question, we just need to compare our valuation, intrinsic valuation based on the H model, and the actual today's share price. Today's share price is 57. Our estimated intrinsic value came at 54. So the answer should be, I'm just correcting the answer to reflect the numbers. So the answer should be that XYZ current price, 57, is higher than its estimated fundamental value of 54. So if you are generating an investment recommendation, your recommendation should therefore be sell, because the company's fundamental value or intrinsic value is lower than its current price. So basically, these are the solutions for the questions that we had for this seminar, essentially. Let us spend literally a couple of minutes, guys, for questions, because unfortunately we're up to the limit of our time. But if you have 1 or 2 burning questions, please just post them in the chat right now, and I'll try and answer if I can. Right, the question regarding the age, is that going to take okay, age, okay guys, so age is the half of the period in years that it is going to take for this growth rate to decline to its long-term rate. In our case here, we have 6 years. So this period during which things will be declining, the growth rate will be declining, is 6 years, right? But age is half of that period, so age should be half of 6, so 3 years. Right. Okay, so I guess we don't really have time for, unfortunately, for any further questions. Can I ask you that you try, guys, and look through these questions again at home in your own time, compare the solutions, make sure that you understand everything, and move on to the next question, which is section C and section D, before our next seminar. I think we have our next seminar next week. So try these DCF and residual income valuation based questions at home. Try to solve them as much as you can, because these are bigger questions essentially. So we want to spend time more efficiently on these questions next time. And as I said, I will post these solutions for the first 2 sections for today's seminar. The Excel spreadsheet, I will post it so you will have a reference point. If there are still any questions left, please feel free to raise them during our next Q&A, or if you spot any mistake, just post it on forum and I'll go back and check if it's a mistake. But I'm now going to end this session now, because I need to rejoin for the other group. Okay, guys. So have a good rest of the day.